We were named the top accelerator in 2016 by CB Insights in terms of the median fundraises of our grads. Y Combinator, which is another famous accelerator, was number 2, and Techstars was number 3. And that's partly why today I'm speaking about fundraising, because I think Alchemist has established a name for having very, very early stage companies successfully close rounds. And about half of our companies end up raising money, and they've raised almost $500 million to date. And these are some of our companies that have graduated, that have raised a lot of money. Our most famous grad is a quantum computing company called Rigetti, which raised $120 million, but we also have phenomenal companies across the board. Okay, and if you're interested in Alchemist, check out the site. Okay, so today I want to equip you with all the insight and knowledge about how venture capital works. And really, the intention behind this is to have empathy, just like you guys have been learning some design thinking and customer development skills for acquiring customers and users. I want you to understand the incentives and the motivations of the VCs when you pitch them. VC, as we all know, is very powerful. It's, just 0.2% of our GDP is venture capital, but it's responsible for companies that generate 20% of our GDP. And those companies are what we famously call unicorns. These are companies that emerge and become worth $1 billion within a certain time period. We call them fictitious, but they're really not. There are unicorns produced every year, and if you look at the numbers, this was in the 2003 to 2010s. This data is old, but typically the numbers have gone up. But it's around 10 unicorns, 10 companies get funded every year that end up becoming worth $1 billion. Okay, the numbers range a bit, but you can use that as a rough proxy, as it's 10 per year. And so I want you to understand what the motivations are for the person sitting across the table when you're going in and doing an institutional fundraise at a VC fund anywhere here in the Valley. And the first thing to understand is how that person makes money. I would normally make this a lot more interactive, and so I apologize, but for the sake of time, I'm just going to lecture to you. So VCs make money in 2 ways, and I'm sure some of you already know this, but they make money on both a management fee and a carry. The management fee is they get a percentage of their fund size every year, regardless of if the fund does well or not. I don't know if people understand this or not. So the way VC works is that a venture capitalist is not investing their money. They're getting the money from their own investors, which are called limited partners. They give that to you, and then they have 10 years to return that money back, hopefully with a return. They're selling you cash, you're giving them equity, and then hopefully the company is going to exit in an IPO or an acquisition. Okay? Now, if they have a $500 million fund, which means that they can deploy $500 million within 10 years, a percentage of that every year is given as a fee. And I don't know if people know what that fee is, but it's typically 2 to 3%. Okay, so if we assume it's 2.5%, what that actually means is that if you have a $500 million fund, $125 million of that fund is going to the partners as a fee. So they're actually only investing $375. They may be recycling that money, but it's $100. But I just want you to understand that. And so typically, in a typical fund, if there is and the reason why I'm going to be telling all of this to you is because everybody's going to tell you pitch a big market. And that's just a conceptual understanding unless you understand the incentives, okay? So this is all building up to that. So a typical VC fund, a typical partner is managing around $50 million. So if you have a $500 million fund, there's usually around 10 people that are involved. And for a $50 million allocation, that represents around $1 million, a little bit more of management fee that partner is accruing, okay? Now, even though the fund is 10 years, when you go in and you pitch a VC for money, let's say you ask a VC and you tell a VC, hey, I only need $1 million, okay? If they give you $1 million check, they know that you're gonna need more money if things go badly, and you're gonna need more money if things go well. If things go badly, you're gonna need bailed out. If things go well, you're gonna need more money to grow. Either way, you're gonna need more money. So even though they give you $1 million check, on their books, behind the scenes, they're actually reserving an additional $2 million. Does that make sense? And so even though the fund is a 10-year fund, after 3 years, they've typically committed the fund. Even though they've only given out a third of the cash, the rest has been committed for your future needs. And so then what do if you're in year 4 and you've committed your fund as a VC and another great igniter entrepreneur comes to you and wants to raise money? Well, you raise another fund as a VC, okay? And so I mentioned that because at any one time, a venture capitalist is pulling down management fee on 3 funds. There is the active fund, there's a fund that's about to die or about to end, and there's a fund that's just starting. And so so just so you, and the reason why I'm going to tell you all this is that what that means is this is all going to build up to a point in a second. But just understand that person that's sitting across the table from you, the VC, they're typically getting, they're managing management fee on 3 funds and about $50 million on each fund, which is about $3 million of income. If you are generous and you assume that half of that income has to go to expenses, that partner is typically making around $1.5 million a year, and they sort of have visibility on that for the next 10 years, based upon how their fund is allocated. I want you to understand this because you and that partner are both going to be on a board together if you get funded, and your incentives are going to be very different, typically. So this is what this is building up to. So the first way that VCs make money that you have to understand is management fee. And management fee creates an incentive for a VC to have a large fund. Because if they have a large fund, they have this guaranteed annuity stream of income. And so to the extent that they can, they want to create a use case to support having a big fund. Now the other way that VCs make money is carry. And carry is just profit sharing. Have you guys heard of carry? You guys know about it? So carry is a fancy word of saying that the VCs get a percentage of the profit of the profit that they create. And typically that's 20%. Okay? And the analogy here is that it's a little bit like catching lightning in a bottle to return a fund. So the way that carry works, just to give you an example, is this is the first Kleiner Perkins fund. This is their fund in 1972. Kleiner Perkins is a famous venture capitalist, and they had a $7.5 million fund. They did 17 investments, and they wrote on average a $450,000 check, and they returned $345 million. Okay, so the companies exited, and their equity positions were $345 million. So to calculate the carry is just the fund returns, 345 minus the size of the fund, which is 7.5, and times 20% of the difference, and you get around $70 million. Does everybody understand that? Just that math. Basically, they're getting 20% of the returns that they are giving beyond the size of the fund. Okay, and so okay, we'll build up to this. Now, if you look at, and this is all going to build up to a point, so stay with me. If you look at Kleiner's portfolio in 1972, if you looked at those 17 investments, 2 of the investments were responsible for most of the returns. Not just most, but over 90% of the returns. Those 2 companies were Tandem Computers and Genentech, and they each returned around $150 or $160 million to that fund. And that pattern has held up over time, where it's typically 1 out of every 10 investments that a VC makes actually has meaningful returns to the fund. And the VC knows that the other 9 out of 10 are not going to be meaningful to the fund's outcomes. And so Silicon Valley and each fund typically follows this power law. There's over 10,000 startups a year, and literally there's around 10 companies that are worth $1 billion or more, and there might be another 15 that become worth $500 million or more. Okay? The other dynamic that's at play here is if you are a VC, if you're trying to create a business model which gives you the most money for the least amount of time, the way you're going to do this is you're going to try to have a very big fund because you get management fee, and you're going to do the least investments you need to do to reasonably and with the least risk return that fund. That is the least amount of work. Does that make sense? So there's some sensitivity here. If I only do 1 investment, then my fund is highly sensitive. If that 1 investment fails, then I'm doomed. But if I do 1,000 investments, it's a ton of work, I'm not going to serve those companies well, and it's probably marginal, the returns that 1,000th investment gets. So there have been a lot of people that have done these assessments on what size portfolios have to be, and the magic number is 30. Oh, so I'll get to this in a second. Is around 30 investments. If a VC does more than 30 investments, there's no incremental return from a beta diversification perspective. They've hit their returns. And so the way most VCs operate, if you're at one of these institutional funds, is they'll raise as much money as they can within reason, and they'll make 30 investments. Okay? And what that means, just to make this really clear, is that they know that 1 out of every 10 of those investments is going to be a real winner. So of the 30 companies that they fund, they know that 3 are going to actually matter. Okay? The other thing they know is that even though we're limited in terms of that there's only these $10 billion companies produced a year, and there's maybe 25 if you include the companies that are worth $500 million or more, that they're limited in how much ownership they can get in it. Because if they try to get too much ownership, if they try to get 80% of the company, you as a founder are not going to be motivated to build a big company. And if they get too little, there's not going to be any meaningful return for them. So there's usually this sweet spot between 15 to 40% that the VCs allowed can take, which is the maximum they can take and still keep you motivated. I say all this because that is the game that the VCs are playing. They're constrained in terms of how much ownership they can take, and they're constrained in terms of how many realistic billion-dollar companies are produced a year. There's only 10 to 25 of companies that are going to become meaningful. And they are also trying to do that by only doing 30 investments a year. Okay? And so what that means is it is almost impossible for them to return their fund if they cannot invest in one of the 10 companies that gets produced that's going to be worth $1 billion that year. And just to make this really clear, and this is all the underpinnings about why people are going to say pitch a big market. If you go into a VC and you say, Miss VC, I will sell you 20% of my company if you give me $1 million, okay? And she says, okay, I'll do the deal. And you say, I guarantee that in a year, I'm going to sell the company for $25 million. You're going to get a 5x return on your money. I want you to understand what the incentives are. So from your perspective, once you get funded, you're both going to be on a board and have to make a decision about whether or not the company should exit a year later for a 5x return, $25 million. From your perspective, a typical post-Series A funded CEO will be making around $150,000. If you own 20% of that company, when it exits at $25 million, that you stand to make $5 million. Okay? That is 30 years worth of work. That is a significant outcome. The way the VC sees the same deal is that the VC is making around 10 times as you as a salary, about $1.5 million. Okay? If you exit for $25 million, and let's say the VC owns 20%. You sold $1 million for 20%. Their take home is $5 million to the fund. The carry on that is 20%, or $1 million of that $5 million. And if you have 10 GPs in that fund, their take home bonus for that exit is $100,000, okay? Which is around 2 weeks worth of work. Okay? So you're looking at the same outcome. You're both on the same board. And you're saying, I just made you a 5x return in a year. This is a great outcome. They're looking at that and thinking, I just wasted only one of 2 investments that I could make in that year, because the fund is only making 30 investments, and I individually can only do 2 investments that year. And for my investment, I got a $100,000 bonus, and I only got $5 million to pay back a $500 million fund. So that is a complete waste of my time. Which is why the only thing the VC cares about is, can your company have an exit that can pay back a third of their fund? They know that there's going to be 3 companies that are going to be meaningful, and they know that they can roughly own around a third of your company. So your fund size exit, your exit has to be equal to the size of that fund. And they don't really care about anything else. I mean, they care about how much they're going to own, Are you realistically a company that's going to be worth $1 billion or more? And if you are, can I own 25% or 30%? If you have those two things, the VC does not care about how much cash they have to give you. So if you're asking for $1 million, you might as well ask for 3 or 4. They don't really care. They just want to make sure that it's going to be a big outcome and that they can own 25%. And the biggest currency that you have when you're going into negotiations is not your traction. The biggest currency that you have is the fact that the VC there's only room for one VC, one big institution, to take a 25% stake in your company. And if you truly are one of those companies that's going to be worth $1 billion, and there's only 10 of them a year, then that VC can't afford to wait when you have traction, because then there will be a countervailing problem where there'll be multiple VCs trying to chase you. And the VC can't get access, they can't get into the company. So the art of fundraising is understanding that dynamic and really orchestrating a process by which you can signal that you are one of the 10 companies that's going to be worth $1 billion, and that VC has privileged access to you. Because fundamentally, what a VC is thinking, even if they're not going to be overtly saying this, is I think that there's two real fundamental. So the archetype that we use within Alchemist about describing a VC is that VCs are hunters. So if you have empathy for a venture capitalist, it is the issue with their job is that they've raised this beautiful fund. They have this beautiful business model where they have a guaranteed high salary for 10 years. And that whole model is just predicated upon them finding one of these 10 unicorn-like companies every year. They just have to find one of the 10, okay? And so the conundrum for a VC is, can they go and chase and find one of those 10? If they can't get into one of those 10 companies, their business model is going to be almost impossible to maintain. They won't be able to return their fund. And so the dynamic is that the VCs, we like to think of the VCs as hunters. They're hunting for these unicorns. And when they see you, what they're thinking in the back of their minds, whether they're explicit about it or not, is one, are you any good? Are you really one of the 10 out of 10,000 startups that's going to actually become worth $1 billion? And if you are so good, why are you talking to me? Okay, if you are so great, why haven't you been funded already? And so the art of fundraising is you need to get around those hacks. There's a lot of ways to do that. Part of the reason why we even set up Alchemist is because there's instant signaling that you are good, you've been accepted, and the VC's getting access to you because of a privileged relationship with us, and then we create an auction effect amongst the VCs. But there's dynamics where you can do this yourselves. You can also create that effect by really just running and driving a disciplined process. What I wanted to focus on was more of the substantial things around, beyond just the cosmetics of running a process and the psychology. And there's a lot of hacks around that, and if we have more time, I'll talk more about those. But what I wanted to talk about now is thinking about how do you actually build a company that's worth $1 billion. And the way that I'm coming at this is from the perspective of, this is Archimedes, and Archimedes has this principle that if you give me a lever long enough and a fulcrum in which to place it, I can move the earth. And the idea here is that architecture, if you architect something for the same amount of effort, you can get these unbelievable results. The reality, if you're starting a company, is that starting a company is hard. Okay, if you want to start a mediocre company, it's going to be a lot of work. If you're starting a company that's going to fail, it's a lot of work. Either way, it's a lot of work. So if you're going to be spending a ton of time, you might as well go big. It's not more difficult, it's not more work to create $1 billion company than it is to create a $10 million company. In fact, I would argue it's a lot easier to create $1 billion company, because if you go after a big market, there's a lot of resources that are going to get poured into you because of the dynamics that I just described, because of how the venture capital industry works. And if you bootstrap something, or if you just try to do something that's going to be more of a hustle, it's going to be a ton of work, and you're going to get to a good outcome, but you won't necessarily get to this $1 billion outcome. So if you're going to be in the business of trying to go down the rabbit hole of Silicon Valley entrepreneurship, then you might as well go big. And what I'm going to talk about is dynamics around how to create $1 billion venture. So the key insight on this is, if you want to go from $1 million today to $1 billion in 10 years, which is the VC time frame, you can't get there by walking linearly. everybody understands the difference between linear and exponential. Linear is if I walk linearly, it's 1, 2, 3, 4, 5. It's additive, it's discrete, it's whole business. Exponential is 2, 4, 8, 16, 32. It's multiplicative, and it drives exponentially. And the idea here is that if you can architect your business using certain levers so that it will naturally grow multiplicatively, you can be venture fundable. And VCs aren't going to articulate it this way. This is sort of the Ravi Balani thing. But the reality is that VCs have to chase exponentially architected businesses. Otherwise, they cannot return their funds. To go from $1 million, if all of you today are worth $1 million, by the way, I hope I'm talking to the right audience. How many people here are founders? Or, okay, good, okay. So, let's say you're starting a company today and you're worth $1 million. To get to $1 billion in 10 years, you have to grow 1,000x. To grow 1,000x, you have to grow 10x 3 times. Okay, so to grow 10x 3 times over 10 years, you have to go 10x every 3 years, roughly, which means that you roughly have to triple every year and a half. Does that make sense? So you have whatever the value driver is of your business, you need to have that be in a curve where it's tripling, if that's revenue, if that's active users, every 18 months to be on the course to have one of these billion-dollar outcomes. And we all, just to make this more self-evident, architecting these things is not necessarily clear from the outside, but it is clear from the inside, and then it manifests in these beautiful ways. So this is the growth of the internet from 1966 to 2001. I need to update my charts. But the main point here is that this is on a logarithmic scale. And so if you look at it, it looks fairly predictable. The growth of the internet was growing at a fairly steady clip. But if you put it on a linear scale, it looks like this. And it looks like, whoa, something really dramatic happened in the 90s, and suddenly the internet took off. The reality, though, is that if you were from within the internet, you're like, no, nothing really changed. I was just growing at a steady clip. It's just that you didn't see it until it manifested in the linear world in that way. Does that make sense? So similarly, if you get these things architected correctly, these businesses, as they grow, they can take off in these ways that just become profound. And so, depending upon the multiple, you'll get there within 5 to 10 years. If you double every year, it's going to take you 10 years. If you quadruple, you can get there in 5. And there are companies that have done this even more. I don't know if you guys saw Slack. Slack is I think they have the record for the shortest unicorn puberty period of any company now. They went from launch to $1 billion in 9 months, which is, and I think before that was Yammer, which was funding to $1.2 billion exit in 4 years. But these things are contracting, but basically you need to be on some type of a hyper-exponential curve. Okay, and we understand the difference between exponential and linear. So let's talk about drivers for exponential growth. The first driver I want to talk about is gross margins. And these are just some basics on starting companies and why VCs might pay attention to this. Gross margins are not the profit that you're making from a company, but the profit they're making from a sale. So it's just whatever the revenue is you get from a sale minus the cost of goods. So if I sell you guys a cookie for $1 and it costs me 50 cents to buy all the ingredients, my gross margins are 50 cents. Does that make sense? It's a proxy for differentiated value. So if you buy a $100 bottle of wine at a restaurant, who keeps what piece of that value is the value chain. But the key thing that I want you to understand is that if your gross margins are 50% or less, you will not be growing. You'll be on a steady 0x slope. So if I was going to sell you guys a cookie right now for $1 and it cost me 50 cents, I sell one cookie, I make 50 cents of profit, I can make one more cookie. Okay, so if I'm just funded by my internal capital, I'm not going to take off. If I can shift those margins just marginally, from 50% to 67%. So if I'm like, these are Igniter founders, I can charge you more, and I charge you $1.50 instead of $1, suddenly I'm making $1 as profit, or 67%, and I can make 2 cookies, okay? So, and then if I sell 2 cookies, I can make $3, make $2 in profit, and make 4 cookies. Does that make sense? So just by shifting the margins from 50% to 67%, I suddenly grow multiplicatively. Okay, so it's a very simple thing, but it's a very profound thing. And this is why VCs are going to ask you about your gross margins. This is why VCs hate hardware businesses, because you have a cost of goods, there's a bill of materials, among other things why they hate hardware businesses. And this is why they love software, because software doesn't have just 67% margins, it's virtually 100%. When you do a Google search, the cost of servicing you is the energy costs on the server. So it's basically nothing. And as every incremental percentage that your gross margins go up, the multiplicative power goes up nonlinearly. So you go from 67 to 75, and suddenly you're tripling your multiplicative power instead of just doubling. So the one thing to first focus on are your gross margins. And more broadly, thinking about not only your margins, but thinking about how you're getting paid. If you don't want to get venture backed, if you hate the idea of raising outside capital, if you can have 75%, because that will give you enough money to maintain the current business and then also continue to fund new growth into your business. And the biggest expense that you're going to use venture capital for is sales and marketing. And so if you can collect your cash up front and have somebody prepay for your service, then you can forward hire your sales team without needing to borrow or get money from a VC. You're going to basically be using the money from a VC to hire salespeople or distribution. Fed by the outputs of technology itself. So if you're building a new chip, the very devices that we use to build new chips are computers that have chips. So there's this positive feedback loop in technology where the outputs